Wall Street splits on AI as bubble fears clash with growth forecasts. A heated debate is dividing Wall Street as financial experts clash over whether artificial intelligence represents a dangerous investment bubble or a sustainable growth opportunity that could reshape the global economy. The disagreement has reached fever pitch in October 2025, with prominent analysts and financial institutions taking starkly opposing positions on AI's future. Mounting bubble warnings signal growing concern. The warning signs are multiplying. A Bank of America survey revealed that 54% of global fund managers now believe AI stocks are in a bubble, identifying this as the paramount tail risk globally. This marks a dramatic surge in anxiety among institutional investors, representing a shift from cautious optimism to outright concern about potentially unsustainable valuations. Jamie Dimon, CEO of JP Morgan Chase, has publicly predicted a serious market correction within the next 6 months to 2 years. However, Dimon offered a nuanced view, telling Fortune that you can't look at AI as a bubble, though some of these things may be in the bubble. He compared today's AI enthusiasm to the early days of the internet, suggesting that while individual projects may fail, the overall technology will likely deliver long-term benefits. The International Monetary Fund and Bank of England have issued stark warnings about potential market disruption. The Bank of England cautioned that global markets could face a downturn if investors become pessimistic about AI's future, noting that the risk of a sharp market correction has increased. Meanwhile, IMF Managing Director Kristalina Georgieva warned that bullish sentiment about AI's productivity potential could turn abruptly, threatening global economic growth. Goldman Sachs champions AI's trillion-dollar promise. Countering the bubble narrative, Goldman Sachs has emerged as AI's most vocal defender on Wall Street. In a report titled "The AI Spending Boom is Not Too Big," Goldman economists argue that current investment levels are sustainable and could unlock an $8 trillion opportunity through productivity gains. We are not concerned about the total amount of AI investment. AI investment as a share of U.S. GDP is smaller today, less than 1%, than in prior large technology cycles, 2 to 5%. Goldman analysts estimate $8 trillion in present discounted value for capital revenue unlocked by AI productivity gains in the U.S., with plausible estimates ranging from $5 trillion to $19 trillion. Larry Fink, CEO of BlackRock, has also pushed back against bubble fears while announcing a $40 billion acquisition of Aligned Data Centers. There is certainly a skyrocketing amount of capital being put to work. If you put it in a framework of geopolitical positioning, we as a country need these investments if we're going to be the leader in AI technology, Fink told CNBC.